Hi everyone, Happy New Year's. Hope you guys are all doing well. Today I will be conducting a lesson and tutorial on buying a call option, right? So as you all know, we have four scenarios when we trade options. We can buy a call, we can buy a put, we can sell a call, or we can sell a put. So every lesson, for at least for the next four videos, I will go through on one each session, and today our focus will be on buying call options. So bear this in mind throughout the whole lesson to avoid confusion, and let's get started. As usual, we have our disclaimer, and if I were to summarize this slide, it's saying that we are not doing day trading or forex. And as with everything we do in life, there's always a certain level of risk involved, and it's strictly for education purposes only. The content today is as shown. I will go through the basic of what is a call option from a buyer's perspective. Fundamentally, what does buying a call option mean? Its advantages and disadvantages, and then I'll share how I use them to profit from the markets. And at the end, we'll have a bonus session on how do you navigate the platform a little bit, what are some tabs to look at, where to find the option chain, and what do you click to execute the buy order for a call option. I'm using Thinkorswim. If you're using other brokers like Arete brokers, then it might not be so relevant, but personally, I like Thinkorswim a lot in terms of the interface. So what is a call option? In the context, always remember that you are the buyer for today. So what does it mean to be a buyer of a call option? If you buy a call option, you buy the right to purchase 100 shares of a stock at a fixed price upon expiration. So this pre-agreed price is also known as what we all call the strike price. Call buyers also have the right to exercise their option, and exercising your option means that you can decide to activate this authority and own 100 shares of the stock at your agreed strike price. And obviously, for this right and authority to control and lock in the purchase price for a set period of time, you have to pay a fee, or what we all call as a premium. Remember, the number of shares in option contracts is always measured in denominations of 100. Next, when you buy a call option, you are bullish, and being bullish means you expect the stock market to go higher, and you expect the stock which you bought a call option on to eventually go higher. Alright, cool. So now that you know this basic knowledge, now let me help you remember what or why buying call option means that you're bullish. So here's an example. Say we have a very famous software company, Microsoft, ticker symbol MSFT. Let's say right now Microsoft is trading at $200 and you are bullish and you think that this stock will go up in the next 1 to 3 months. Right? You buy a call option with a strike price locked in at $220 at a premium of $150. So what this means is you have the right to buy 100 shares of Microsoft at $220 per share at one point within this 1 to 3 months, and if you do so, your actual cost of owning Microsoft shares is in fact only about $121.50, right? Because even though you paid a $150 premium, this $150 premium is for 100 shares. So each share actually you're only paying $1.50 to have control over for this period of time. However, that being said, let's make things simple for now. Just ignore the $1.50 and think of it as you already have the ability to own 100 shares of Microsoft at $220. Now let's assume 1 to 2 months later, Microsoft went up to $240, as we see on the slide. Here's the kicker. Even though Microsoft is at $240 now, you can own 100 shares of Microsoft at only $220. Therefore, your profits is actually $20 USD per stock, and each contract is 100 stocks, as I mentioned earlier, and therefore your net profit will be $20 multiplied by 100 shares, which gives you $2,000 USD of profits per contract, right? Next, let's move on to the advantages and disadvantages of buying a call option. So if you've been with me since 2020, you will know that I always advocate risk management, and as a call option buyer, this is very good for risk management. Why? Well, if you look at the graph on the slide here on the right side, This graph is common if you try to search it online, but it's usually not explained well, so please listen carefully. Recall from our previous example, Microsoft, you paid a $150 premium, right, for the right to buy 100 Microsoft shares at $220. The beauty of buying call option is if the stock goes to zero, your maximum loss is only the premium, which in this case is only $150, right? So that's why you see the y-axis is the profit and the x-axis is the share price. Let's say if the share price goes to zero, yeah, your max loss is only $150, regardless of what the share price is. I know going to say that Microsoft goes to $0 is an extreme example, but this just helps to illustrate my point, right? So if you compare it with someone who, let's say, owns 100 shares of Microsoft, right, at $200, means they didn't buy a call option, they actually bought 100 shares of Microsoft at $200. They need an upfront of 20K, and if Microsoft goes to $0, then they lose 20K, whereas for you only lose $150. Now if Microsoft goes up, right, your profits are unlimited, right? Because no matter what price it goes up to, $250, $300, you still have the right to own it at $220, right? So the higher it goes, the more unlimited your upside is. Well, this brings me to my next point. As a call option buyer, you're actually using much less capital to participate in a trade, which can yield potentially bigger returns, right? You see, let's compare side to side. The same case whereby a person is considering purchasing 100 Microsoft shares, right? If they just buy it from the market, they need 20K, and for you, you just need $150, right? So, it's a much lesser amount needed to participate in the same bullish outlook of the stock. And finally, when you buy a call option, you can choose a reasonable time duration for the stock to go up in your favor. As a general rule of thumb, I like to stick to about 1 to 2 months or more, right? Nothing less than 2 weeks. And a good stock tends to go up in the mid to long term, right? Look at Microsoft 1 to 2 years ago. You see that the overall trend is up, even with all the COVID-19 saga which happened, right? Obviously in COVID-19 it dipped, but eventually in the long-term perspective it will go up. In fact, you can even buy call options with 1 year's expiration. Yeah, so it's actually really interesting. Next, let's discuss on the disadvantages of buying call options. Well, the first point will be, as a call buyer, you have to pay upfront premium, and this is also one of the key reasons why you see so many marketing gurus and ads out there selling expensive courses, right? Because all they teach you is selling options because, you're trying to paint a perfect picture, right? Many people view buying options as bad because naturally as humans, we like to receive money, right? However, the thing is, they're missing out is, you can actually buy for lower price and sell it back to the market at a higher price, which I will discuss on more later, right? Now, point number 2, as a call option buyer, you're bullish, right? Which means that you only profit from the trade if the stock goes up. If the stock market goes sideways or goes down, you will slowly lose money on the call option contract. Your profit potential is also time bounded. So what this means is any price movement, in your favor after contract expiry will not materialize. So let's say you bought a call option from Microsoft at $220, right? And it expires on the 30th day, right? And let's say on the 31st day, Microsoft goes up to $300, for example. You will not profit anymore because you have already lost the right to purchase it at $220. So this is why call option contracts have expiry dates and therefore they are time bounded. So that's pretty much it for buying call options. No need to overcomplicate things. What was I gonna say? This core knowledge is actually more than enough to set you up nicely for future videos and strategies which I will be teaching. So the next section I will be discussing on how I profit from my buy calls. On a fundamental level, the whole idea of trading and profiting from buy calls is to buy the calls at a lower price than what you actually sell them for in future, right? Or what people like to call buying low and selling high. Many people do it for stocks, but they have no idea that they can do it for options as well. Because most people, they are taught in theory and given the impression that, when you buy a contract, you have to hold the contract all the way to expiry, but that couldn't be further from the truth. So I hope you learned something today. If you see the slide, it shows a trade I did in January 2021. I did Microsoft. I bought a 19 February 21 call option with strike price 220, and I paid a $260 premiums, right? So I have about 1 month for the day from the day I entered the trade for it to go up. And after 1 to 2 weeks, I think it was 1 week, Microsoft went a lot higher and the contract is now worth more. In fact, at one point in time, it was worth about 820 US dollars, right? So if I close the trade, I make a difference of $820 and $260, which works out to be around 560 US dollars, right? So not bad for a return in 1 week. So this is why the time duration is also important when choosing your trade, as the general rule of thumb and based on my experience is 1 month is ideal, as it gives your trade time to recover if it does not work out so well at the beginning, right? And further to that, Microsoft is a decent stock, so it can drop, but it can't really drop forever, right? Eventually it will recover. So here's another example which I like to use to remember some what a buy call option is for myself when I first in the context of COVID actually. So let's contextualize it a little bit. Let's say it's the start of March and COVID happened and the stock market crashed, right? Due to panic selling, bad news, fear, uncertainty, etc. And in mid-March, the price of Disney ticket, yeah, aka your stock, is only $80, right? Now you bought a call option for September 2020, which is about 6 months, with a strike price of $100, and then you paid $2, which is per share, which is a premium of $200, yeah, for the right to purchase the tickets for only $100 in the future, right? So fast forward in June, the prices of tickets start to pick up to say $90, right? And now your call option might be worth say $400, right? And because the likelihood of Disney tickets going higher increases, and you still have about 3 months for that to happen, so you can sell the call option back to the market and earn $200 USD, because you paid $200 for it, and now you're selling it back at 400 USD. You'll make a delta of $200 USD, right? So that's one way. That's what we also call as options trading. You trade the option, you buy and sell it, yeah. However, let's say you're very patient and you still think Disney has the opportunity to go up and the economy will eventually recover even more. You can have patience, right? And then let's say in August, nearing the end of the 6 months, the economy recovers. There's vaccines available and there's some stimulus package from the U.S. Government and the Federal Reserve. Now Disney tickets are selling at $120, right? Because it's safer to go out now and people can visit Disneyland. You can still own the tickets at $100 because you still hold a contract and they're still valid, and therefore if you exercise the option or if you close it out, each contract will make you $2,000, right? Because now Disney tickets are trading at $120. You can own it at $100, which means that you make $20 per share. And if you have 100 shares per contract, you make 20 multiplied by 100, which is $2,000. So that's about it. I think just to try to keep it short and sweet. Essentially, I've already covered all the main points. And right now, I'll just move on to the bonus content, whereby I'll show you how to execute the trade and how to find it, etc. So, yep, I'll direct you to the next video. Thanks for your attention. Hi guys, welcome back. This is a bonus component where I'll show you what to look out for and how to execute your buy call option. So first thing you want to do is navigate through the Thinkorswim platform. If you look at the top corners, there will be a few tabs. You want to go to your trade tab for options, and then you can see that there's the option chain here. So you can view all the chains and like what's available in terms of the days to expiry. There's 21 days, 42 days, 1 month, 2 months, 3 months, etc. And let's say I think that Disney will go up in the next 20 days to maybe 180, then probably I'll look at the 21 option, click to open it up. So to navigate it, just take note that the call options here are all on the left and the put options are on the right. so do not confuse yourself. And the strike price and expiry dates are listed in the middle. So let's say if I think that Disney will go up to a 180 price, yeah, I want to look at the 180 strike price with 21 days to go, which is 19 February, yeah, and the price and or the premiums which I need to pay for this call option will be $430, right? Just remember, whenever you buy options, you want to look at the ask price, right? Not the bid price, but the ask price. The ask price is the price or the premiums which you have to pay in order to have the right to control 100 shares of the stock at a certain price. So to execute a trade, just go to the strike price, then head over to ask column. Let's say I want to buy it for 430. Click on the left click on the 430, and make sure your quantity is 1. Yeah, in default it's 10. So what you can do is you go to setups, application settings, auto defaults, choose options. I think in default, if you're new, you'll see it to be 10 contracts, so switch it to 1. Okay, you can apply, and yeah, it'll be 1. Next thing to note is always choose mid price. Yeah, naturally the contracts or the brokerage will choose the net price. So net price is the natural price, which is also the highest price for the contract. So you want to always choose mid price because you get a better deal, right? So in this case, just by choosing the mid price, I save over $10 USD, right? The mid price is basically the middle price between the bid and ask spread. So yeah, it's just the cheapest price, and you just want to, for a start, it's good to always choose the mid price. And then you can click confirm and send. And don't worry, they will not execute yet. They will still have this order confirmation dialog where you can just double confirm is what you want. You see, I bought one Disney contract at a strike price of 180. It's a call option, and I paid $420 of premiums for this. Yeah, and my break-even price, profit loss is all included here. Yep, so that's about it, and yep, enjoy.